Hi everyone, I'd like to introduce a brief clip which includes Hugh Hendry, who's very bearish on the market. The reason I'm interested in this clip is because the opening statement is suggesting that quantitative easing and the Federal Reserve's policy of throwing money at the problem will inevitably lead to hyperinflation. Hugh Hendry counters this using the argument that Japan have been using quantitative easing for decades without creating even inflation, never mind hyperinflation, so it doesn't necessarily follow that putting money into the system by quantitative easing will lead to hyperinflation. I made a video on this subject a little while ago which I'd like to put a link to in the more info section, and I would like you to take a look. But let me just let this clip run for a few minutes and listen to what Hugh Hendry has to say, please.
If you believe in fundamental economics, then at some point this must be inflationary.
Inflation. I think what we can say categorically is that the inflation scare from the relative price highs in commodities was a head fake. It was a head fake at a massive cyclical turning point for the economy. This is profoundly deflationary. We keep talking about monetization, quantitative easing, huge budget deficits. All of this is untested. Japan has been the proponent and been the only one to pursue quantitative easing. Where is the Nikkei 18 years later? It's still making new lows. So quantitative easing isn't necessarily a panacea. And for all the talk about rising levels of government debt, it's occurring at the same time as corporate and personal sector debt is contracting. So they're cancelling themselves out and they're leaving us with this deflation.
Okay, so how could printing money actually fail to produce inflation or hyperinflation? Well, the answer is very simple. There are two sides to the equation. You can put money in at one side, which the Federal Reserve are doing, 800 billion here, 800 billion there, bailing out IIG, whatever the hell they're going to do. But the other side of the equation is the absolute massacre of equity and valuations within all markets, the housing market, derivatives, the stock market, the amount of buying power, for which is basically money, but it's not just money. I mean, buying power is potential money. For example, if in 2006 Mr. A owned a house which was valued at $1 million and he'd paid 500,000 for it, then he had $500,000 in equity, which at any point he could release into cash and use that to spend into the economy. So it was potential buying power. If the houses devalue by 50%, then he loses that equity and doesn't have access to the option to turn it into cash. And as we know from one of my other videos, where does the money go when prices collapse, all that's happened in that equation is that the last sale price, which sets the valuation for all similar goods, changed. In other words, when houses were selling for $1 million, then Mr. A's house was valued at $1 million without him having to do anything. When the price is halved, the last sale price, the last transaction, set the price for all similar houses. In other words, he lost the fantasy of the valuation. And this is happening all over the markets, derivatives, stocks, houses, and that is the other side of the equation. And because the scale is so immense, because whatever cash has been put into the system by the Federal Reserve is multiplied through debt and through the fractional reserve banking system and so on, which expanded the buying power and expanded the economy and made the bull market, as that contracts, it contracts at, if not the same scale, even more. It's like one huge global margin call. People are forced selling in every single market, and that's what the Federal Reserve are up against. And if the money they put in at one end doesn't get multiplied through loans and fractional reserve banking into something which can counter and swamp the deflation which is going on, then the Federal Reserve and the other central banks are basically just pushing on a string, and it's meaningless. You can try at this end by pushing money in, but pushing on a string means that has no necessarily no effect at the other end. You can't control what the end result is. Now, of course, in a small economy like Zimbabwe, for example, where there are not that many Zimbabwean dollars. So when the government started printing Zimbabwean dollars in order to service massive national debt, the sheer scale of their printing managed to overwhelm the number of Zimbabwe dollars in circulation, creating hyperinflation, which then led people, the people using the money, the currency, to have higher inflation expectation, which means that they spend now because they fear that prices are going to be higher tomorrow. In deflation, the opposite is true, which is what we're experiencing now. People are beginning to save for a rainy day again. And what that means is that money is actually being drawn out of the economy. And therefore, it's not going into spending and it's not in there bidding up prices. So therefore, prices continue to fall. Now, there's a lot of talk about the US dollar going the way of the Zimbabwean dollar, simply because the Federal Reserve and other central banks around the world are printing so much money, quantitative easing. Print it and throw it out there, get the thing going again. However, there is a huge difference with the US dollar, and that is that it is the global reserve currency, which means that oil is traded in dollars. Much of the global trade is done in US dollars, and therefore the number of US dollars in existence is just, it's unimaginably large. Trillions and trillions of dollars. So yes, $800 billion here and there. Yes, bailing out AIG and Citibank is a big deal, is a lot of money, and it's putting more money in, and therefore it is technically inflationary. However, in the big scale of things, compared to the sheer volume of dollars in existence, is it enough to make a difference, particularly when, as I've discussed, at the other side of the trade is this deflationary effect. So the difference between the Zimbabwe, which experienced hyperinflation through printing money, and the US, who some people fear might experience hyperinflation because of printing money, is that the sheer volume that the printing needs to overcome is just on a different scale altogether. Now, that doesn't mean that I'm writing off hyperinflation as an eventual outcome, because when the economy begins to pick up again in future and the curve turns and we begin to get inflation back, the Fed's problem then is going to be reining this thing in. Reining in this monster that they've created in order to try and combat the monster that they see as of deflation. They've created a new monster to battle it. If that manages to win and we do get back into growth and a little inflation, then that thing could take off just an absolute rocket ship. Then their problem would be to rein it back in. But that is not the problem we're facing right now, and there's no guarantee that that's the problem we're going to be facing. But you know what? Just to finish this video off, here's quite a surprising thing. I would say still, even though I'm talking now about deflation continuing, maybe turning into high inflation eventually, but for now deflation continuing, I still say look at buying gold. I don't have the time in this video to discuss that, but maybe sometime soon. Thanks, bye.